In trading, the one who usually earns the most is the one who knows more and understands the market more deeply than others. But what if the most information you are studying is not true and only prevents you from achieving success? Today, I will destroy the 8 myths that binary option traders believe in, and I'm sure that you or your friends who watch this video believe in at least a couple of them. You're on Alice Binary Guides channel, and we don't just tell myths, we destroy them. The first and probably the most common myth is that binary option traders can influence price of assets that they trade on. Many people think that massive purchases or sales on binary options can change the market dynamics. So is that actually truth? So I'm gonna destroy the first myth because in fact, binary option traders do not buy or sell assets themselves. Instead, they buy options, which in simple words mean that they are essentially betting on whether the asset price will be above or below a certain level by the time of expiration. For example, in football, betting on a team does not change its real strength or chances of winning. So in binary option trading, it's the same thing. We do not affect the price of asset in any way. And if we go further and ask the question, do retail traders influence the price of an asset? The answer will be a bit more interesting because in fact, yes, since they do acquire assets by changing supply and demand in the market. But in reality, their trading volume is so small that the effect is minimum. In fact, the price is influenced only by institutional traders and large banks. Of course, there are exceptions to this rule. When, for example, a lot of retail traders gather in one place and they can significantly affect the price. And by the way, an excellent movie on a real story of GameStop was shot on this topic, and it's called Dumb Money. If you haven't watched it yet, I definitely recommend it. But in any case, the myth number 1 has been busted, destroyed, and binary option traders do not affect the price. This is just the beginning of the video and we will move on to more interesting myths, but before that, I would like to remind you that your likes and comments help us create more useful content. So if this video turned out to be useful, don't forget to smash that like button and subscribe to the channel so you won't miss any of my new videos. Myth number 2, technical analysis doesn't work. Considering the fact that my trading is based solely on technical analysis, I think you understand my opinion about this myth. So I don't even see the point in just saying that technical analysis actually does work. I better try to explain it to you and show why it does work. When we're talking about technical analysis, it's really important to understand what are you actually analyzing. We're not just talking about green and red shapes on the chart. We are analyzing real supply and demand on the market. So basically, we are trying to understand what are those big players that we talked about in the previous myth, what are they going to do? We need to predict their actions. So, is it possible? Of course, it's not possible always, but really often it is actually possible. Let's look at this example. The price was actually rising till this level, and right here the sellers are turning on and the price is moving down. And this price actually worked in this price corridor 3 times, and then the price fell down. And somewhere in this level, enough sellers were actually interested in putting their actions into the downtrend. What's happening after that? In future, this level is going to work multiple times, and because this is the reliable level and a lot of players are interested in lowering the price, selling their actives, and that's why the price dropped right here, here, and here. And of course, you will never be able to predict the market mood all the time. So for example, here we see that there is a big player or players and the price is skyrocketing. And of course, there is no guarantee that this is not going to happen. And even though the price went to that level, it doesn't mean that it's going to drop instead of like breaking through this level. But in most cases, you can see that in places like that, we can expect the price to drop. So let's look closer. Right here we can see that the price was growing, and right here we see this candlestick. The buyers pushed the price upwards, and the sellers are actually trying to push it downwards again. And the reaction from the sellers, from the buyers, I'm so sorry, they dropped the price, and we can actually work with that. And the same story is right here. We see that the price reached this level, and the buyers, the sellers reacted. I'm so sorry. But if someone is telling you that their strategy of technical analysis gives you more than 90% of win rate, just don't trust that. I have never met anyone who actually does that, because there is always an element of something unpredictable happening on the market. Levels are breaking and something else is going on. So naturally, technical analysis will not allow you to predict further price movement in 100% of cases, but it will definitely allow you to find patterns and predict the price direction correctly more often than incorrectly. And I wanted to remind you that with adequate money management, it's enough to have 55% win rate for profitable trading. And in my experience, with a competent analysis, it's more than realistic to achieve 70 to 80%. So this myth is also busted. Myth number 3, signals are a fast path to wealth. It sounds logical. So if you find a cool trader and copy his trades, you can get rich quickly, right? Wrong. 99.9999999% of signals result in losses. If we talk specifically about binary options, there are many reasons why you're more likely to lose money on signals than earn. Firstly, those who give signals often have a conflict of interest. Most of the people who give signals do it for free with only one condition. You need to register using their link. So if you register using an affiliate link, the one who gave you this link will receive a commission from the broker for your trading. In fact, there is nothing wrong with this. We use it ourselves to monetize our academy. But it is important to understand that there are two types of commissions. First one is a turnover commission, is when the broker pays a certain percentage of the amount of traders' bets. And the second one is revenue share commission. And in this case, the broker pays percentage of the lost money. So most of those who give signals use revenue share because they can directly affect your losses by giving you obviously bad signals. As a result, the one who gives the signals is gonna be interested in making them bad. Secondly, there is time delay. More often, binary option trade is really fast, within expiration time of like 1, 2, 3 minutes. And in such circumstances, it's really important to enter into a trade at the same moment as the one who gave you the signal. Otherwise, the results might be different. And of course, the problem is that it's physically impossible to do that. So after opening a deal, the signaler must take a screenshot, write down the name of the currency pair and the expiration time and the direction of the transaction, then send it to his channel, after which you must find the same currency pair and repeat the transaction. And at best, this process will take you 30 seconds. And when trading for like just 1 minute, this is too big of a difference, and often you result with just different results and losing money. Of course, most importantly, by copying signals, you do not learn anything and completely depend on other people's predictions and results. And that basically means that you're simply wasting your time. What I can say is that signals can be useful only in one case. The VIP students of my academy have access to a channel with our trades, but these are not signals to copy. No, in fact, it is a trader's diary, looking at which students can analyze how we apply theory in practice and ask questions learning in process. Success in trading comes through constant training, practice, and analysis, and this is not a quick path to wealth, but it's a long-term process that requires patience and diligence, because most successful traders have gone through many mistakes and losses before achieving stable profits. So at the end of the day, the myth is busted. Signals carry much more harm than good. Myth number 4. Candlestick patterns do not work on short time frames. There is an opinion that candlestick patterns are effective only on a long-term charts, and they are useless on short time frames, especially in binary options. For the most part, candlestick patterns are needed for us to understand what's going on the market right now during like one or a couple of candlesticks. And for the most part, yes, if the candlestick pattern is on the really high time frame for like 1 hour or a couple of days, it's gonna work much better than on the short ones, on the short time frames. But what's really important to understand, they are still working because they still have the same meaning. So for example, right here we see an uptrend. After we see that there was a inside structure of a downtrend, we have our swing low, our swing high, and this drop is happening inside of a global uptrend. So basically we are expecting the deal for an uptrend, of course. So the price is dropping and dropping and dropping, reaching this level. And right here it is pushing the support zone. It's not pushing even lower, it's somewhere in the middle, right? So potentially we understand that there is a good place for us to enter into a deal. And right here we see 4 candlestick pattern. It's called a free line strike, and it basically consists of 3 red candlesticks. The price in terms of like 3 minutes, it was dropping, and the last candlestick is absorbing all the 3 previous candlesticks. That means that the price was going down, and then there is a really big impulse from the bulls. So the price reached the minimum that it was supposed to reach, where the buyers became active. And of course we understand that this is a bullish pattern, and we are expecting the rise of price, and we can see that it's actually happening. So of course the myth is busted, but I will admit that there is still a grain of truth in it, because candlestick patterns on higher time frames are more important. Myth number 5. Technical analysis is useless without fundamental analysis. So there is an opinion that without understanding the fundamental factors, technical analysis doesn't make any sense, especially in short-term trading. Fundamental analysis, without a doubt, helps us to see the overall picture of the market by tracking factors such as economical indicators, political situation, and even natural disasters. All of this is important, of course, but in a world of binary options where trades open for just a minute and hour at the most, technical analysis plays a key role. It is technical analysis that allows you to quickly respond to intraday price fluctuations. Often the price begins to move gradually, and that's when technical signals like support and resistance levels, trend lines, candlestick patterns, and indicators, they become our best friend and assistant, because they help to predict the price direction and make timely decisions. So fundamental analysis is important, but the myth is still busted. By the way, if you want to deeply understand the use of indicators and learn how to correctly analyze the market, join my online academy. In this academy, I have not only created a detailed online course, but also constantly help my students personally. And the course is of course completely free, and in order to start learning right now, you don't need to do much. The course is available on Telegram, and you can join by simply texting me personally. And the link is, as always, in the description under this video. Myth number 6. Price always reacts to the news instantly. And in fact, it's closely related to the last myth that we talked about of fundamental analysis. Many traders are sure that the price instantly reflects all the news that has been released, and it's impossible to predict this movement. But in fact, the market reaction may be delayed because traders and investors often need time to analyze the information they received and make informed decisions. Often before the release of breaking news, the price begins to enter a consolidation phase, forming graphical patterns such as triangle, for example. And this stage of equilibrium between buyers and sellers may signal a strong movement ahead. After the news is released, the market often reacts with this particular breakthrough, which corresponds with expectations of traders. And thus, observing technical signals before the news allows you to predict and prepare for a significant price movement, increasing the chances of successful transactions. Myth number 7. Indicators are more important than price action. So, some traders believe that this is impossible to make informed decisions without indicators and that they are more important than price action itself on the chart. Indicators are initially mathematical formulas expressed in more user-friendly charts and lines, and they do not predict anything by themselves, but they rather react to data from the past, which is why they are so often late. So my opinion is that indicators should be used as a confirmation tool to enter a trade. And initially, you definitely need to focus on price action, since it's the price action that reflects the real market mood. And last but definitely not least, myth number 8. Big startup capital is a guarantee of success, because many people believe that a large startup capital is needed for successful binary options trading, and they think that the more money they invest, the higher the chance of profit. It is not the amount of money that's important, but actually its management, because even with a small deposit, you can succeed if you manage risks correctly and follow a strategy. But I mean, of course, with a really small deposit with just like a few dollars, it's impossible to comply with adequate risk management. But at the same time, thousands of dollars are definitely not needed for this. In general, in my opinion, it's better for a beginner to trade on a demo account for a couple of months at least at the beginning of their journey, and only after that use real money, because that's the only way you can avoid losing lots and lots of money at the start. In this video, we talked a lot about price action and price analysis, and if you want to understand this topic of market analysis in more detail, I actually made a separate playlist on this topic, and I recommend that you definitely watch it. And that's gonna be it for us for today. Thank you so much for watching, and I will see you in the next one. Bye bye.